Right. Morning, everyone. Welcome back to our morning kappa. So I'm Joseph here. So look at the Hang Seng Index. It continued to move sideways yesterday. It inched up slightly higher, but overall the index have yet to climb above the 20 days moving average. So technically, right, the Hang Seng Index are still undergoing consolidations right now. But on the bright side, right, the Hang Seng remains above this critical psychological support, i.e. the 25,000 point level. Now, as such, we deem the overall technical setup remains bullish right now. As of what we see last week is that the some of the tech stock start to actually regain momentum again at the Hong Kong market. So hopefully, with this big tech counters regain their momentum, right? It could lift the index higher, break past, cross above the 20 days, and then followed by breaking past this 26,000 point resistance. Um, so as for the trading stock this morning, firstly, we'll be looking at the UB Tech Robotics stock code 9880. So right now it's testing the resistance at 115 Hong Kong dollar. If breakout happens, UB Tech will be climbing towards 125 and followed by 135. Downside support is marked at 105. Secondly, we have the China Gold International Resources, stock code 2099, eyeing to extend their bullish trajectory, testing the 150 resistance. So if breakout happens, this 2099 be climbing towards 160 and followed by 170. Downside support is marked at 136. As for the uh, SXXP, which is the Euro market, right? Last week it was having here, but during the week it managed to climb above the 20 days and 50 days, and right now it's eyeing to retest the resistance at 560. So in conjunction with the bullishness in the Euro market, we do see that XMP 500 also climbed above the 20 and 50 days last week. Propelled higher by the tech stock as well. So on the Friday sessions, when the US resumed their trading sessions, a few counters that attract my attention. Firstly is the INTC, the Intel, right? It have moved on a very strong momentum, right? Then on, we do notice that a few tech stocks like the ADI, analog devices, then on the MCO technology, right, as well as the Lam Research, all these semiconductor related counters are also moving on the upward basis. So hopefully the sentiments returns to the tech stocks in the US market. And so far, the US S&P have almost testing the 6,008, which is this blue color line, 6,008 resistant. Okay, right. So as for the Malaysia market, the FKLI experienced a very strong corrections last week, uh, but it still stay above the 1,006. So hopefully it will continue to stay above 1,570, and as of now, we still keep bullish bias unchanged. As for the FCPO, it continue on the counter trend rebound, and it have moved up for the third consecutive sessions on the Friday. Um, this week it will be eyeing to cross the 4,150 resistance and the 4,250. So we still keep a bearish bias with our stop loss mark at a 4,250. Also in conjunction with this downtrending 200 days moving average. So as long as stay below this 4,250, we'll keep the bearish bias unchanged on the FCPO. Now, as for the trading stocks this morning, we'll be looking at two counters. Firstly, the UEM Sunrise. So last Friday, the volume have picked up again, showing that the bullish momentum re-accelerates. So if it managed to break past the 61 cents resistance, now UMS should climb towards 65 cents and followed by 68 cents. Downside support is marked at 56 cents. Now, secondly, we have Kerjaya Prospek Group. Now, they have released their latest quarter results, and looking at the price actions right now, they are testing the resistance at 2 ringgit and 85 cents. So the breakout happens, Kerjaya will be climbing towards 2 ringgit 95 cents and followed by 3 ringgit and 5 cents. Downside support is at 2 ringgit and 75 cents. So we have two pending breakout now, Sunrise and followed by Kerjaya Prospek. So I stop here and pass the stage to Xian Yong on the Mingguan, Rasa Mingguan.
Thank you, Joseph. Let me share my screen first. Morning all. Thanks for joining the call. So this week we could see some pullback in the risk sentiments as the recent Fed result has showing that the beach book is telling a weakness story, especially coming from labor market and consumer. And also, notwithstanding of the view, we are seeing the FOMC trajectory probability still pointing to cuts, which is around 0.8 for now. This is as opposed to our view with no FFR cut and also another two more cuts in 26. So in contrast, the initial Joseph claim has fell slightly to 216K thousands per in the latest week of ending 22 of November, and this shows some slight improvement in the labor markets. Other than that, as I mentioned just now, the beige book, this is economic conditions telling by Fed. So we can see some downside in the consumer spending after the government shutdown, as well as there's a fall in auto sales. Meanwhile, manufacturing has slight some increase due to as tariff still remain a headwind, and also other than that, including non-financial service and loan still remain flat because due to a declining household confidence. As we look at labor market, layoff is on the uptick, and employment has shown some small decline, and also our adjusted has changed instead of headcount. So this telling the people that they are more cautious in hiring, and also the AI adoptions has replacing a lot of entry level roles. So we suggest that labor market likely to stay weak after the shutdown. One thing to support our view is that toward the Fed cut is that one's key ally from Trump called Kevin Hassett, who might become the next FOMC chair after Jerome Powell, is that he speculate that they would likely further rate cut. So, however, if this rate cut doesn't view doesn't hold until next week, so we might see a further decline in the global risk sentiment index, where we see that current level is around 2.5, and this if this fall even further, we might see a further risk off sentiments. So other than all this, we also see some data coming in the fund flows. Skip this. So in Malaysia, so we can see some easing outflow from Malaysia, which is including equities and bonds. And also this could further reinforce ringgit appreciations. And also on Singapore side, the net inflow has persisted but still weakening. So this suggests there's a limited downside bias for the SGD for the short term. For Thailand, the fund flow has moved into info territory in this week, and also we can see that this likely suggests there's a slight increase in the global confidence. But for Indonesia, the fund flow still remain outflow because the weakness on the fiscal front still remain challenging. So that's all from me. I will pass on to David for the banking side. Thanks.
Okay, thanks, Yong. So we have today the CIMB's third quarter results. The third quarter results are in line with our as well as consensus. They reported net profit of 2.1 billion ringgit. This was up 10% Q on Q and 2% year on year, bringing the 9-month 25 earnings to 5.9 billion ringgit. This was flat year on year and at 76% of our and consensus full year estimates. Reported ROE 11.3% is well within the 11 to 11.5% target for 2025. The key surprise though was they declared a special dividend of 7 cent, and we will talk a bit more about this shortly. The results, the sequential rise in net profit as well as the year-on-year increase was actually driven by two things. Firstly was higher non-interest income. This was up 20% Q on Q, 18% year-on-year from fees as well as the treasury as well and FX, which comprise both sales as well as the trading components, and the non-loan ECL write-backs due to corporate restructuring having completed, which we also saw several banks reporting the same. Apart from that, margins was down 7 bips Q on Q. This was due to Malaysia and Singapore, lower rates as well as lower OPR, but cushioned by higher NIM in Indonesia as well as Thailand. Loan growth still quite flat. Deposit growth still outpacing loan growth because of CIMB's focus in terms of the having a liquid balance sheet, which at LDR of 86.5%, this is actually one of the more liquid banks we have seen. Asset quality also really no major issues. The gross impaired loans was actually lower Q on Q and year on year, mainly from Malaysia and Indonesia. Now, again, CIMB declared a 7 cent special DPS. This was a surprise because firstly, typically the dividends they tend to declare in the second as well as fourth quarter. So third quarter is really an off quarter for dividends. And secondly, also the surprise was that this is part of the 2 billion capital repayment plan, capital return plan that management has actually announced during the results briefing. So this 7 cent will take up about 760 million or thereabouts, and the balance management plans to return that evenly over the next 2 years, which translates to about 5.8 cent dividend per share. So with that, we have actually raised our DPS forecast by 13 to 17 cent, and CIMB's yield is now in an attractive 6 to 7% dividend yield going forward. No change to our forecast, but we have actually raised our target price to 8.55 from 8 ringgit 40 cents after rolling forward valuations. We keep our buy call on CIMB. This is still our sector top pick, as you know. Previously, we were positive that CIMB will benefit from Indonesia's improving liquidity situation. And now with the capital management plan, that actually further helps with our positive outlook as well as thesis on CIMB. Okay, that's all from me. I will pass you to Adam.
Okay, good morning, everyone. So today we have a company update on Kerjaya post briefing last Friday. So we remain upbeat on Kerjaya Prospek, given that it now potentially aims to secure 2 billion worth of new jobs for FY25 versus the initial target of 1.6 billion. So the the revision in the job replenishment target for FY25 mainly comes from its ongoing tenders that are made up from residential and industrial jobs, which part of it comes from data centers. And we view that moving forward, jobs from the ENO Andaman Island to continue to keep Kerjaya Prospek busy, as ENO aims to target about at least 1 billion ringgit worth of GDP in terms of launches every year. So that could translate to about 400 to 500 million worth of job values for Kerjaya Prospek annually. And not to forget that there's also some unreclaimed portion of the Andaman Island Anama Ane is only 70% reclaimed, and then there's another 30% that has yet to be reclaimed. That should, be about 300 to 500 million worth of potential job, that Kerjaya Prospek could eye for in terms of reclamation works. And in terms of its property development arm, it has about 89 acres worth of land bank spread across Klang Valley, but mainly in Penang. And some of those land bank could see some development progress, which could be sometime in 2026. So this should definitely provide continuity, on top of its existing property jobs, which one is the view at Monteres and one is papayas at North Mount Kiara, which total up to about 800 million worth of GBV. So in terms of what the existing land bank has, that has at least about at least 1.5 billion GBVs or above. So all in, we are reviewing we are estimates by 3% higher for FY26 and 27 as we revise our job replacement target higher for FY25 and FY26 from 1.6 billion to 2 billion. So with that, we arrive at a new target price of 3 ringgit and 45 cents, previously 3 ringgit and 35 cents. So any potential related catalyst would be if Kerjaya were to secure any new jobs from the industrial space, given that the last job secured was sometime 3 years ago. So that's all from me, everyone. Pass on the floor to the next speaker, Aidil. Thank you.
Hello, hi everyone. So Padini's released their first quarter results. This quarter was in line with expectations, contributing about 12% of full year forecast, consistent with its seasonally softer first quarter. Core net profit came in at 21 million, down 1.8% year on year, but up 98% quarter over quarter, reflecting margin improvement and leaner operating costs. Top line grew 2% year on year to 400 million, supported by new stores, including their first standalone store at Limbongan, Melaka. The key highlight for this quarter would be their margin strength, as gross profit margin expanded to 40%, up 4.3% year on year, driven by better sales mix, as well as favorable sourcing costs from the strengthening ringgit. On dividends, Padini declares ahead of reporting. So first half FY26 dividend per share is about 3.6 cent versus 3.3 cent last year. Looking ahead, near-term sales should strengthen as we enter the festive and school holiday period. Despite cautious spending behavior, we believe demand for affordable fashion should remain cushioned as shoppers downtrade towards value alternatives like Padini. Tourism-linked demand could also pick up ahead of VMY 2026, and a stronger ringgit may ease sourcing costs and keep the gross profit margin at around 39%, which is at the current levels. Their overseas exposures looks contained, despite the ongoing risk from Thailand and Cambodia tension, as Malaysia sales remain the biggest market contributor at 97%. On the valuation side, we upgrade to buy and maintain a TP at 2.16, implying a 20% upside and about 4% FY26 yield. The stock trades at one standard deviation below its 5-year mean, providing a good entry point as seasonal momentum builds into second quarter as well as third quarter. So I think that's all from us. Thank you and have a good week ahead.